later. You should receive a recording later. All of the participants for today have been muted, but if you do have questions, please feel free to use the chat function, and we'll try to address those. We're going to try to keep this as conversational as we can and to try to address questions as we go along, so please don't hesitate to use that. Let's see, before we start going through the slides, Robert, do you want to just introduce your team that's there with you?
Let's see, I think I'm unmuted. Hi, my name is Robert Arnall with FineMark National Bank, and I have the pleasure of my colleagues with me today, Cassandra Pullis, Nick Caddy to my right, and then Tom Litton next to Nick. Between the four of us, we were the group that were responsible for the implementation of PPP, loan originations, and now we're working on the forgiveness piece. So these are my experts. Hopefully they'll be able to answer your questions, and we're happy to be here.
Terrific. And I think we're going to defer a lot to you. I think a lot of people are understandably, we sort of know what the statute says, we know what some of the interim final rules say, but I think a big question mark is how banks are going to handle some of these applications, and even more so how the SBA is going to respond to them. So with that, I'm going to kind of dive in and start going through. I wanted to just begin with a little bit of background that people probably are familiar with at this point, but it's sort of helpful to think about how we got here and what some of the issues are likely to be as we move into the forgiveness phase. So the Paycheck Protection Program obviously was a key part of the CARES Act that was passed back in March. It generally offered low interest, forgivable loans to most businesses that had 500 or fewer employees. Businesses were eligible to borrow up to 2.5 times their average monthly payroll, not exceeding $10 million. And then those funds could be used for payroll, mortgage interest, rent, utilities, a couple of other less common things. And sort of best of all, amounts that were spent during an initial 8-week period could be forgiven if they were spent on payroll and then qualifying mortgage interest, rent, and utilities. And we've seen that one of the issues with this program is that because of the way it was rolled out and because of the sort of unprecedented level of crisis and confusion, is that a lot of the details have changed, and it's been challenging to sort of keep pace with the requirements. So, initially the covered period was an 8-week period. That has since been expanded to 24. Initially, loans had to be repaid within 2 years. That's since been extended to 5. And even the amount that had to be spent on payroll, initially it was 75%, now reduced to 60%. And so we've seen just some pretty significant changes to the loan forgiveness terms, even since the program has been up and running. And in addition to that, we've learned that the SBA, or at least they have said anyway, that they will be auditing all loan forgiveness requests in excess of $2 million. And so that, I think, led to a lot of second thoughts and some concerns among borrowers as to what that audit was going to look like, whether they were qualified in the first place to certify that the loan request is necessary for them to, in light of the economic disruption, that they in fact needed the loan. And I think still it's fair to say that we don't fully know what the SBA's criteria are going to be in reviewing the loan applications. I don't know if, Robert, if you or your colleagues have more insight to this point on what SBA is looking for. I know that, as recently as a couple of days ago, they had received something like 96,000 forgiveness requests, and I believe had not yet acted on any of them. I don't know, Robert, did you want to add anything to that? Have you heard anything from SBA in terms of what they might be looking for?
You mean as far as from an audit standpoint? No, we have not. Thus far, we have not received any requests from SBA of for any documentation for any of the applications that we've submitted, but we're still very early in the process. We did receive one request for information, but it wasn't related to an application for forgiveness. We're not sure why they asked about that particular borrower. But we do know that anything over $2 million, as you said, is going to be audited. Anything under $2 million has basically been, at least from the safe harbor standpoint of the did you need the money attestation, anything under $2 million, they're saying you are deemed to be met that safe harbor, but you're still subject to audit. They can audit any loan at any time, basically at their discretion.
Right. So, in terms of when to apply for forgiveness, interestingly, there is no hard and fast deadline to apply. What the PPP Flexibility Act says is that if a borrower hasn't applied for forgiveness within 10 months after the last day of its cover period, the borrower then has to begin making interest and principal payments to the lender on that date. So, just sort of logically, you would think that virtually all borrowers that are eligible for forgiveness will want to do their forgiveness application certainly within 10 months, if not earlier. On the other hand, given just the sheer amount of the guidance that's come out and some of the contradictions and sort of reversals by SBA, some borrowers may prefer to wait until there is more certainty about how the process is going to work. And in fact, there is legislation currently pending in Congress that would make loan forgiveness requests for $150,000 or less. They would make that, almost a, rubber stamp where you would submit a single-page application. I know that the sponsor of that legislation has said that the $150,000 threshold would account for 86% of PPP loans, but less than or just slightly more than a quarter of PPP loan dollars. And so, I can certainly imagine some borrowers that may not want to go through the time and the stress of trying to complete a longer application if it's the case in a few weeks or a couple of months that they're able to submit a really streamlined one-page application. And again, as I kind of alluded to, the SBA forgiveness portal is open. Some banks are still not accepting loan forgiveness applications, or some are sort of rolling it out slowly because of questions about how forgiveness is going to work. And so we still haven't seen a huge number of borrowers actually file their forgiveness requests. I think as of just a few days ago, there have been about 96,000 forgiveness requests, just 2% of the total number of loans. And as I said, I don't believe, unless it's changed within the past day or two, I don't believe that the SBA has granted forgiveness in any instances. I know there were some news articles saying that they intended to do so shortly, but I don't believe that's happened yet. Suhas, in your experience with your clients, have you seen people wanting to apply right away, or are borrowers sort of preferring to wait it out a little? I think you're still on mute, Suhas.
Okay. Most of our clients, this is what is happening. on the street. Some of them want to apply, but their banks are not even ready. Their portals are not ready. That's why they are not applying. But there are quite a few clients that want to apply after the end of the year because of this confusion whether Congress is going to pass any legislation making the expenses deductible or not. And so most of our clients are not ready to apply, and the ones that are ready, some of whom that are ready to apply, their banks are not ready to accept the application. I'll also share my particular experience. My firm applied, and it was a community bank, and this community bank and most of the community banks are actually better prepared than larger banks, and they accepted my application. There were a few inquiries which were answered, and our application is already in the SBA's hands. So I think the experience is mixed. It depends upon the bank. Also depends upon the clients, because some of the clients that have huge payroll, they are struggling with filling out the application because of the sheer amount of data that is required. Does that answer your question?
Right, and we'll talk about that in just a minute. That the forgiveness applications really are not they're not particularly long, but they can be very complicated. And I know I've had people asking questions already about how to fill out particular parts of it. So as I said earlier, SBA has published I think something like 25 interim final rules. There are still some changes that are potentially on the table that Congress could make to the program. The tax treatment of PPP loan proceeds is somewhat up in the air, and we'll talk about that toward the end. But there are some questions about how the loans are going to be treated for tax purposes. And really, there generally is no disadvantage to delaying an application, and in fact, there may be some advantages for those borrowers that have had to either reduce their full-time equivalency or their level of full-time equivalent employees, or that have had to reduce their salaries and wages that they pay to employees. The delaying the application may give them a bit more time to see what's going to happen and if they're able to either restore positions or restore salary before the end of the year. But I think there may be situations where borrowers just want the certainty of knowing that their loans will be forgiven. There may be situations where perhaps they have other debt or other lenders, and they may just need the comfort of knowing the amount that will be forgiven and the amount that they may be stuck borrowing.
Ivan, if I may, I also think there's an advantage to applying after the end of in the next year rather than in 2020, because there will be more clarity from tax perspective too.
Mm-hmm.
Ivan, do we have any insight yet as to how long it will take the SBA to process a forgiveness application once it's submitted by the borrower's bank?
If I'm not mistaken, the SBA said in a rule that they intended to process the forgiveness applications within 60 days of being submitted. But I don't know, as a practical matter, whether they will in fact be able to do that. I don't know if Robert or others can speak to that.
Yeah, Ivan, the law actually says that a bank accepting an application for forgiveness has 60 days within which to review the data and make a recommendation to the SBA. Most banks, particularly banks of our size, community banks, probably aren't going to take that long, but we have that leeway. Then once it's submitted to the SBA, they have up to 90 days to respond by law. They hope, they have said they hope to respond sooner. We haven't had any sitting out there at the SBA waiting approval yet for long enough to know really how long it's going to be. The longest one we have out there is probably 2 weeks.
28.
We have one out that's been out 20 days and we've not had an answer yet. I suspect that given the volume that they're going to have, at least early on in the process, they'll be taking every bit of that 90 days. And I believe there may be some provision, I have to do a little more research, where if they request additional documentation, the 90-day clock gets reset. So we've jokingly said, on day 89, you're going to get a request for additional information and they're going to go reset their 90-day clock. But I would plan on 90 days from the time the bank submits the request to the SBA before you get an answer.
Yeah, well, I think, I just sort of have the sense that the SBA has been understandably sort of overwhelmed with these. I think it is a fact that they received more loan applications the day this program opened than they had received the entire prior year. So you just sort of have to imagine that they're going to be overwhelmed, particularly when they start, auditing the loans of $2 million and up, with whatever that is going to entail.
Yeah, everybody was just overwhelmed by this program, not only the SBA, but the banks that were called upon to actually make these loans. And you mentioned earlier the 25 interim final rules. They're making this up as they go along, largely as they incorporate other federal regulations that come into play and impact the program. How does this fit under the overall regulations of the 7A program? We asked a question early on about the effect of mergers, and that was before this most recent announcement on mergers that came out last week. But the response that we got was referred us to the 7A guidance and a 467-page document on how to deal with mergers. Fortunately, this latest guidance that they came out with is provided a great deal of clarification. It's a much simpler process. But the SBA is challenged with making these loans fit under all of their other regulations that they're subject to, and I think they're struggling with it a bit.
Mm-hmm. Yeah. So let's transition to talk about the actual loan forgiveness applications and what borrowers will need to do and to sort of have on hand to complete the application. So the SBA has two distinct applications. There's the Form 3508 and then the EZ form. And certainly, as the name implies, the EZ form is shorter, it's easier to complete, it requires a little bit less information. One of the things that I found interesting and a little bit surprising about the EZ form is it really does, it sort of covers different time periods. So in both instances, whether you use the EZ or the regular form, you're comparing the level of employment that you had during your covered period, which is generally 24 weeks, or some borrowers can elect 8 weeks, and then you're looking at any reductions in salary or wages. And then, at least for FTE, you're comparing that to, you have the option to compare it to either period from the spring of last year, February 15th to the end of June 2019, or the first 2 months of this year, or there's a different option for some seasonal employers, or a third option for some seasonal employers. With the EZ, they're looking instead at whether your FTE and reductions in salary, how they compare during the covered period relative to basically the first quarter of 2020. And so it's a different comparison period, and it sort of struck me that it seemed like that EZ form would maybe be most appropriate for businesses that, in effect, had not had any reductions in their FTE or salary and wages, since the beginning of the year or since February 15th. Which is a little different than what's in the statute, but maybe that's just the price of using the EZ form if you're able to. And then, as I understand it, some of the banks are using their own forms and online portals, which I think are going to have to be virtually identical to the SBA forms, but I suspect that maybe banks would ask for borrowers to perhaps retain different information. I don't know, Robert, are you asking borrowers to do anything different than what's on the Form 3508 and EZ?
No, our applications are all done electronically, just like we did on the origination side. Fortunately, we're able to process them that way. I can't imagine banks that are trying to process these with paper. It would just be a nightmare. But and so our application and our platform mirrors the applications. And when you log in as a user, as a borrower, one of the first things it's asked is, do you meet the criteria for using the EZ form? And essentially, the criteria is, did you reduce your FTEs by more than 25% or reduce anyone's salary during the covered period? For most of our borrowers thus far, we've seen where they did not. So they continued paying everybody, kept their payrolls basically the same. We did have one applicant who was a seasonal employer, and they chose a seasonal time period from last year. As you mentioned, if you're seasonal, you can go back and pick the time period that you want to use. And what they did is they went back to a time period last year where they had typically had fewer employees during that time period, and they used that as their comparison to this year. Now they did get a little bit of a haircut based on their FTE reduction and their salary reductions, but at the end of the day, they were still able to qualify for 100% forgiveness based on their payroll expenses alone. So that was a big advantage, but they had to go through and complete Schedule A, which is a very tedious document to complete. Fortunately, our software provider has provided a really good Excel workbook that our borrowers can fill in the applicable employment information for their employees, upload that to our system, and it completes the 3508 for them based on the information that they submitted in the Schedule A. I think you'll find that the majority of banks will have a similar online system that will handle these applications in a similar format to what our software provider is doing.
Jeffrey or Suhas, have you found just practically that any clients are they having difficulty just finding the information that they need or with the tediousness of the process?
I think it's can you hear me?
Yeah.
It is a tediousness of process. I agree with Robert. I think for filling out this the Schedule A is a very tedious process, and because if you think about this, you have to get the information of at least a year and a half of payroll information on a week-by-week basis or bi-weekly basis filled out to calculate all this stuff. So most of the clients are in search of or are using Excel workbooks. Our firm actually developed a Excel workbook and worked with few software developers to populate the information from their accounting so payroll system straight into a workbook. But there are a lot of workbooks out there, and but it is still a tedious process unless that workbook is aligned with the accounting and payroll software.
Well, Jeffrey, were you going to say something? Oh, okay. So let's talk specifically about the 3508 EZ and who's eligible to use this form. So 3508 EZ can be used by self-employed individuals, independent contractors, or sole proprietors who have no employees. So that's obviously going to be a fairly small group, and necessarily that's going to be a group that's applying for loan forgiveness in a very small amount. In fact, I don't think they can apply for more than and it's $20,800. And then the other group that's able to use the EZ are borrowers who did not reduce salaries or wages by more than 25% during the covered period compared to the first month of the year, and either did not reduce the number of employees or average paid hours of employees between January 1 and the end of the covered period, or were unable to operate during the covered period at the same level of business activity as before February 15th due to compliance with federal guidance related to COVID-19. And specifically, they reference the Health and Human Services and CDC and OSHA. A couple of things to note about that. There are some exceptions for employers that may have reduced employees but can show that they attempted to rehire employees who were let go or whose hours were reduced and were unable to, and were also unable to hire similarly qualified employees. And with regard to the federal guidance, SBA has come out with a pretty helpful rule which says that if your business was not able to resume the same level of activity due to a state or local shelter in place or shutdown or similar order, that also qualifies as federal guidance because those orders typically are based at least in part on federal guidance. So I know I've talked with a couple of clients on those issues specifically, and sometimes it can make it even a bit more complicated because then they have to start going through and figuring out, well, was it, if their FTE did decline, was that due to an employee voluntarily leaving or reducing his or her hours? But there is that exception there to keep in mind. And then some of the other specific information that is needed to complete the 3508 EZ includes number of employees both at the time of the loan application and at the time of the forgiveness application. In general, as I think I said at the beginning, only businesses with 500 or fewer employees were eligible for PPP loans, and with a few exceptions for certain industries. Payroll costs during the covered period are capped at $100,000 per employee as prorated for either an 8 or a 24-week covered period. So, for example, if you have a business that elects an 8-week covered period and they had an employee who earned $20,000 during those 8 weeks, that amount qualifies for forgiveness, but only to the extent of $15,385, which is the prorated $100,000 for that period. And then, in addition, businesses can take into account and can apply for forgiveness with respect to the employer's contribution to state and local employee taxes paid by the employer, the employer's contribution to health and retirement plans, and to certain other benefits. And that's in addition to the per employee cap. However, in the case of owner employees, there are some slightly different rules that apply. So if you have a member of an LLC, partner of a partnership, or a greater than 5% owner of a C or an S corporation, there may be slightly different limits to their compensation, or at least to their amount that is forgivable, as well as complete caps or an inability to also claim forgiveness with respect to amounts contributed to their retirement or health insurance. I don't know, Suhas, have you seen any, I guess, difficulties or confusion arise there with respect to what amounts are includable?
No, no, because in most of the cases, what is happening is our clients are coming to us for guidance, and so we are able to guide them properly before the confusion sets in. So, no, not really.
Yeah. I know that for some, and it fortunately hasn't been a huge problem, but I know that in some instances, employers, may not necessarily track particular employees' hours, especially if they're, salaried employees. And so sometimes there's been confusion about how many hours do you treat them as working, do you treat them as being full-time or not. And so I've seen, as I said, fortunately it hasn't created huge problems, but there can be some confusion there about how to treat particular categories of employees.
So Ivan, there is one confusion I've had is where we have, and probably I don't have clarity, is when you have an employer with multiple LLCs or S corporations where the owner is working in all this corporation, that is he eligible for $20,800 or on each of this company or what?
Right. Well, and I think that's been now clarified. I know that question came up early on, and I think there was a rule which said that in the case of an owner, you're eligible for a maximum of, I think it's $15,385 for an 8-week period, or potentially longer for a 24-week. But that's in total across all businesses. So, and I know some people that have that exact situation where you might own 4 or 5 businesses, maybe all of them applied for and received loans, you're performing services, and all of them, you can't double or triple dip. You can only pay yourself up to $15,385 one time. And that, I think, is just sort of consistent with the idea that this program is designed to promote keeping employees on the payroll and not necessarily to be a windfall for owners.
Right. That makes sense. That's the spirit of the law, so correct.
Ivan, one nuance here is that with respect to partners in partnerships or LLCs, the compensation that's forgivable is based on 2019 self-employment income, not what they earn in 2020. So that can make a difference.
I agree with you.
That's right, and I think that's a great point, because I think I think I said sort of maybe a bit too generally that it's capped at 100,000, but it's really for an owner it's the lesser 100,000 for their 2019 compensation. So you can't or I should say the prorated amount of their 2019 compensation. So if you were an owner of a business that applied for a loan and you earned less than $100,000 in 2019, that effectively becomes the cap, whatever that prorated amount is for your 8 or 24-week period. And then, the other non-payroll information that is required to complete the EZ is business mortgage interest payments, business rent or lease payments, business utility payments, and those can't exceed 40% of your forgiveness amount, or said another way, payroll has to account for at least 60% of your forgiveness. And then another question, what information, in addition to the form, what has to be submitted with the 3508 EZ? And there has to be documents verifying your cash compensation and non-cash benefits. Usually these would be things like bank account statements, third-party payroll provider reports, your employment tax forms, proof that the employer contributed to health insurance and retirement. And then likewise, for non-payroll, you have to show documents that prove both the existence of that you made the payment and that it was an obligation that existed before February 15th, 2020, because mortgage interest, rent, and utility payments are only eligible for forgiveness if those particular mortgages or rentals or utility payments were in place, or utilities, were in place before February 15th.
Yeah, that's all right, Ivan. There's a couple of nuances, particularly as it relates to non-payroll costs, that I think are important to note. One is as it relates to business mortgage interest payments, that only applies to loans basically in the borrower's name that are secured either by real property or personal property. If they have working capital lines of credit or things that are not secured, unsecured interest is not allowed as a non-payroll cost. Also, as it relates to business rent or lease payments, you mentioned that the lender, the borrower is going to have to document that the lease was in place, so the lenders are going to require a copy of the lease to show that it was in place as of February 15th. But also, there's a nuance that came out a couple of weeks ago that relates to any joint ownership of related entities. We have a number of clients that own the buildings that they occupy in the name of an LLC, and there's common ownership. So in the instance of when there's common ownership of anyone that has more than 5% ownership in the borrowing entity, common ownership in the entity that owns the real estate, then you are limited to deduction of the interest that was paid on any debt related to that property. You can't claim 100% of the rent. And in some cases, those borrowers don't have debt on the property. So in that instance, it's our understanding that the amount of rent paid is not an allowable non-payroll expense in that circumstance. Suhas, would you agree with that?
Yeah, I agree with that completely. But Robert, I do have one question for you. Talking about the line of credit. So most of the working capital line of credits are secured by blanket lien on corporate assets that includes furniture, fixtures, equipment, and sometimes there's a building, sometimes it's not there. Do you consider that interest deduct as eligible or not?
Yeah, I would say if there's a security agreement that states that there's a blanket lien as evidenced by a UCC filing on all of the business assets, it's secured by the business assets and would be deductible.
You got it.
Right. And then there's also a lot of information that borrowers are asked to retain for 6 years, but are not necessarily required to submit with their application. And that includes the document that supports their certification that salaries or wages were not reduced by more than 25%, documentation regarding any job offers and refusals to accept a restoration of hours, voluntary resignations, for-cause terminations, and things like that. Since those don't count against an employer for purposes of determining FTE, the employer's got to retain records that show that in fact they properly did not reduce FTE for that reason. They need to retain documents supporting their certification that they didn't reduce average paid hours of employees between January 1 and the end of the covered period, and then that they, if applicable, that they were unable to operate at the same level of business activity. I actually have a question sort of for the group, and I don't entirely know the answer to this, but how do you look at that, the certification that says that the borrower did not reduce average paid hours between January 1 and the end of its covered period. Do you think of that as a snapshot, that you look at January 1 and the end of the covered period, and if at the end the hours are more, then you're fine? Or do you have to literally look at each pay period within that period and be comfortable that there was no reduction at all throughout? Suhas, has that come up for you, or Robert, has that come up for you in your comments?
No, we have not had that question come up. It's a good one. It talks about so I think that if you had one employee and you cut their hours by 50%, then you are not eligible for the easy form. You'll have to go the long form route and fill out Schedule A. It's not in the aggregate. It's any one employee is the way I interpret the guidance.
When I look at the easy form, it looks to me like we're looking at basically that first quarter in comparison to the covered period. So I would take the snapshot in time and then compare it to the covered period in which we're actually measuring those hours.
Right.
Mm-hmm. Yeah, I've looked at the form and the instructions, and it's one of those things where I don't think it's really clear. And in a sense, it would be a shame if, an employer, by virtue of, reducing even one employee's hours or reducing one employee's salary, then forfeits the ability to use the easy form. But I think that's maybe just another area in which there's still a lack of clarity.
I think, this is Tom, I think there's an answer in two ways. First is FTE count. And I think the FTE count is, at the end of the covered period, is it greater than or equal to what it was last year? And that's an absolute number. As it relates to payroll, I think it's aggregate. So if you took the payroll, because the way the form works is if my payroll was $100,000 last year and it's at least $100,000 today, this is without Schedule A, then I would qualify under the easy form. That's the way I read it. That's the way the form works.
Mm-hmm.
And Ivan, just even if you did have an employee that you reduced their hours by more than 25%, and you do have to go the long form in the Schedule A, it does take into consideration the aggregate of all employees and the aggregate of total FTEs. So even if you had one, it may not result in a significant haircut to the amount of the loan that's forgiven because it's taken in the aggregate of your overall payroll. It's just that's just the test. Did you have any one employee that you reduced their wages or salary or hours by more than 25%? If the answer to that is yes, you have to use the long form. The impact that will have on your overall forgiveness really will depend on what happened with the rest of your payroll and your employees during that pay period.
Right.
One thing to keep in mind here is that this is talking about that the employer, the borrower, did not reduce the number of hours or the average paid hours. This comes into play with overtime. Sometimes employees, for whatever reason, don't put in as many hours one pay period as another. And that's okay. It's a question of actions by the employer to reduce the hours or pay. So there may be situations that at first look like you're not going to meet the test, but then you have to look into the details more carefully to see why did those number of hours drop. And if it's because the employee decided not to put the time in, that's not going to hurt you.
Right. We had a question about what is the effect of reducing salaries by slightly more than 25%? And that's a great question because it's, as with a lot of this, in the case of FTE, it's proportional reduction. If you had 100 employees during, or if you had 100 employees during the prior comparison period and you had 90 during the covered period, then all else equal, 10% reduction in your forgiveness amount. With salaries and wages, it's actually a dollar for dollar offset. So if you, I'll take a very simple number. If you're paid an employee $100 during the first quarter, and then you paid them $70 during the covered period, and let's assume it's all apples to apples as far as the hourlies and the amounts of time and so on. So that's greater than 25%, it's 30%. You would have a $5 reduction in the forgiveness amount. So it's sort of a dollar for dollar reduction, but only after you exceed the 25% threshold. So thanks for that question. I want to move next to talk about what information has to be submitted with the 3508. And in general, it is the same information that is required to submit the 3508EZ. Plus, you also have to do a pretty involved Schedule A, which is going to require borrowers to do some detailed and employee-by-employee calculations of payroll costs, average FTE, any reductions in salary or wages, compared to, again, as we said, at the borrower's choice, either February 15 through June 30 of last year or January 1 through February 29 of this year. And it really does, the way that the Schedule A and the worksheets are set up, it really does require borrowers to go through line by line, and for each employee, figure out what they were earning, what their hours were, whether they were full-time or not. And there's actually even an alternate method for computing FTE, and so very often it will be in the employer's interest to figure out would they fare better under the regular method, in which you just take an employee's hours each week and you divide by 40, or the alternate method, which basically treats all full-time employees as 1 FTE and everybody else is 0.5.
This is Suhas. This Schedule A is the one that requires a lot of detailed information, and employers with a big payroll. This is where most of the work is involved, and especially when you're filling out Form 3508.
Yeah, it requires a lot of information, and it can be just difficult to fill out. Almost the employer is almost never going to have a payroll cycle that exactly tracks its covered period. So you can get into these thorny questions about, well, if someone was paid for work before the covered period but didn't get their check until in the covered period, how do you treat that? And it just is, it can be very complicated for sure.
So if I may interrupt you, also the complication is we have had some clients where they have, for their field people, they have weekly payroll, and for their office they have bi-weekly or semi-monthly payroll, and this is where Schedule A gets very, very complicated further,
Yeah. So there's a question, someone asked, if we hired an employee at the end of February 2020 and maintained their employment to date, would we still be eligible? We had no full-time employees, I presume, during the earlier period. I guess my question about that would be, on what basis did you receive the loan in the first place if you had no employees in the prior year? If the owner was treated as an employee, and so you got the loan based upon income replacement for an owner, you may be able to use that money, obviously, to replace owner compensation. And I think, although I'm not 100% certain, I think you could use that money, fungibly in a sense, to use it to pay the salary of an employee who's employed during the covered period. But obviously, I think you'll be limited there because your payroll amount is going to be limited by what your payroll or owner compensation during the prior year, and obviously now you have an employee, so presumably you're paying out more in total salary and compensation. And then we talked about, again, what information does the borrower retain but not submit? And it's the PPP Schedule A worksheet, which we talked about is a pretty involved worksheet, and then documentation to support each employee listed in Worksheet Table 1, which is generally employees who earned less than $100,000 the prior year. Worksheet Table 2, which generally speaking is everybody else. The same documentation regarding job offers and refusals, for cause terminations, voluntary resignations, and the like. Documentation about the certification of an inability to return to the same level of activity. And, I want to just note for a second, whether you are doing the 3508 or the 3508EZ, if you have a loan, any borrower, but especially if you have a loan of more than $2 million, it's really critical that you have this information kind of on hand in an organized fashion, because certainly if you got a loan of more than $2 million and you request forgiveness, the audit is going to be a certainty. And so you may be asked to provide some of this information. It's not, it is a virtual certainty that you will be asked to show your entitlement to the loan amount and the forgiveness amount. Robert, are you advising your borrowers to, are you advising borrowers to retain particular information that maybe in addition to this, or are you recommending that they retain in any particular format?
We have not recommended any particular format, but we certainly recommend that our clients comply with the regulation. And all documentation that you've relied on to make some of these attestations, for example, if you're saying that you tried to hire somebody back and they refused, well, typically you are required to report that to your state unemployment agency or some other entity within a certain period of time. So whatever documentation you had for that reporting mechanism, then you would want to definitely retain that. If you were forced to shut down a part of your business, you were a restaurant, for example, and the governor had issued a order that you could only occupy 50% of your business, nobody really knows what that documentation should be, but I presume there is an executive order out there or something in the public records that you could obtain that would serve as that documentation. So we would urge borrowers that as they're looking at that attestation piece on the application, that they just make certain that they have the ability to back that up in some shape or form in case the auditors knock on their door. I think it's very unlikely, quite frankly, that people under $2 million will get audited, but there's always that chance. We've talked a lot about, what's that test going to be? How are they going to determine who they audit? And a couple of us are of the opinion they're going to compare your 2019 tax return to your 2020 tax return, and if they don't see a disruption in revenue and net income or something along those lines, there's a chance that the IRS may flag you for an audit, but nobody really knows how they're going to do that. But
and I would echo, as documentation is concerned, even for those that are not over $2 million, just from a best practices standpoint, for us as an institution reviewing these files, I would suggest keeping it as organized as possible as far as your payroll registers, your 941s, your bank statements, making sure that you know the documentation required from a bank standpoint for us to be able to foot those numbers on a 3508 or 3508 EZ. Even the EZ form, it does not require that on Schedule A, but as far as best practices are concerned, having some kind of worksheet that shows your math so that the bank knows exactly where you got your numbers from and can foot to your payroll statement. That only will help the process for the bank in order to complete and be able to say, yes, you used the money where you said you did. And it just kind of helps our time frame in order to turn that over to the SBA as well.
Yeah, that's a good point. Banks are not required to validate your numbers. However, we are required to do a good faith review of the documentation that you've submitted. As it relates to payroll costs, most of our clients thus far have been able to provide us a report from their payroll providers, ADP or whoever, Paychecks, whatever, and that's very helpful because we can rely on that third-party information. If their payroll is handled internally, then it becomes a little bit more of a documentation nightmare because we may not have all those reports and we may actually also have to get some additional documentation to support it. Same as it relates to non-payroll related expenses. We have to have some mechanism to show that you actually incurred the expense during the covered period. So utility bills, et cetera, showing prior month's balance, ending month's balance, payments made, et cetera. Those are going to be critical and for our review. Fortunately, though, with the 24-week period, what we're finding is thus far in the applications that have been submitted to us, borrowers are able to qualify on their payroll costs alone, and we're not having to use any of the non-payroll related expenses. That helps our review period and process to be much more streamlined, and it also reduces the amount of documentation that the borrower has to retain in relation to their application. We had one instance in a large firm where they actually excluded all of their partners' salaries from the payroll calculation because they were able to make the forgiveness solely on the payroll of their staff based on 24 weeks. So that, again, really simplified their application and simplified the documentation because they weren't having to look at all of those alternative wage periods and who earned what, when, and where as it related to the partners of the firm.
And Ivan, one other point of note for clients submitting applications, I would urge them to submit applications including only what they need to get 100% of the loan forgiven. We've had several instances where clients have submitted payroll records and, in addition, non-payroll expense-related records when they're not necessary. And if those are submitted to a lender, then the lender is required to review them. Therefore, we'd have to have copies of leases and copies of things that at the end of the day are not pertinent to the forgiveness. So I would urge people to only submit what's necessary to get the forgiveness accomplished.
So I would maybe make an opposite point to that, which is that, as I understand it, if you have combined payroll and non-payroll expenses that are in excess of what you borrowed, and so that you actually qualify for more forgiveness than what you borrowed, obviously your forgiveness will be capped at the amount of the loan, but you could potentially have a more forgivable expenses, and in a way, it sort of gives you a cushion to, that way, if for whatever reason there's a reduction in your payroll, let's say, or there's a reduction, that by having those additional expenses, you could still qualify for full forgiveness.
Yeah, that's true, Ivan. But the counter to that would be, let's say, for example, you at your initial review, it appeared that you could qualify just on your payroll costs alone, so that's all that you submitted. Well, SBA looks at your documentation and they don't agree with you, you always have the ability to amend your application later in order to support those other eligible expenses if you needed them to be included. But not including them initially would streamline the process for you and potentially for your lender's review. So it is a fine line on where you want to go with that. From a lender standpoint, we kind of like the less is more format, just simply because we've got, in our case, 540 of these to process. And if we have to sort through a myriad of documentation supporting expenses that weren't necessary for the forgiveness, it just takes time that we don't need to expend.
And I would say a lot of the expenses that we're referring to have been minimal in comparison to what payroll is. So when you talk about utility bills and some other ones that are very minimal amounts in comparison to the loan amounts that were received, it doesn't seem to push the needle either way from our side. When you get to that loan amount, the utility bills and the small items that kind of tack on to your payroll don't seem to move it from our meeting that threshold of the forgiveness amount.
And the documentation required includes all of the bills, all of the check registers evidencing the payment. So to Cassandra's point, it's typically minimal.
Mm-hmm.
And
as we've seen so far, I would say.
And in the applications that we've reviewed, if the math is correct and the payroll records are correct, they're correct. So math is math, right? So if it's correct and accurate, then there should be no secondary issue with respect to other expenses, assuming everyone's done their job.
And it's going to vary from business to business in the nature of the entity. Most of the entities that we've reviewed thus far have been primarily service organizations, physicians, a couple of retail. But if you're a manufacturing firm that has high overhead and maybe high debt associated with that facility or the buildings that you're in, then you may be just the opposite, where you need to bring in all of those other non-related expenses. So each case is going to be different. But again, operating under the less is more principle, keep your documentation to a minimum of what you need, that you know you can document, that you know you can prove, and that will meet the forgiveness level.
Right.
One thing worth focusing on for those borrowers that are service partnerships is that, unlike the one example that was given where they claim the entire forgiveness amount based on employee compensation, another way to look at this is to also include partner compensation, because there may be no loss of tax deduction to the extent the loan proceeds are related to partner compensation. So if the law doesn't change on this issue, you may get a better tax result by including partner comp as opposed to excluding it. So that's something that should not be overlooked.
Jeffrey, that's a great segue to kind of our last slide here. And I know we're starting to run over time, but that's a great segue because we want to talk about some of the uncertainties that are still surrounding the taxation of these loans. I think initially the intent was that these loans would be, certainly they're not includable in borrower's income as loans generally are not, and the statute itself says that they are not, the forgiveness of the loans is not cancellation of debt income, which it might otherwise be. But then the IRS has come out with a ruling saying that you cannot deduct amounts that you use to pay otherwise deductible expenses like employee salaries and wages and so on, if those amounts are later forgiven. There's some proposed legislation that would reverse that to sort of give the borrowers the benefit of both the deductions and the exclusion from income when the loan is forgiven. But so far, those haven't gone anywhere. And so, for example, if you have to file a tax return for 2020 where you use PPP loan proceeds to pay deductible expenses, but the amounts haven't been forgiven yet, I think it's a little bit, and I know Suhas could probably speak to this better than I could, but it's a little unclear how you report that if the forgiveness won't occur until 2021.
So, Ivan, here is this is a $1 million question, and I would pose it to Jeffrey too. Here is the issue: you get the loan in 2020, you use that money to defray your eligible expenses. You get the forgiveness in 2021. Now, the issue here is, first is right now we are in the middle of this political storm, so we don't know what's going to happen and whether the new administration is going to change the rule or not. But let's say that they don't change the IRS rule. The question here is, if the forgiveness happens in 2021 and expenses were paid in 2020, then are you? The question here is, do you deduct those expenses in 2020, and then when the forgiveness happens, do you pick it up as an income in 2021, or do you have to go back and amend the 2020? That is one big question, apart from changing the legislation. And we don't know that. I don't know that. There is no guidance about that from IRS or from Treasury.
It's possible that the answer may depend upon whether you're a cash basis or accrual basis taxpayer. Because if you're accrual basis, I would think it likely relates back, but if you're a cash basis, who knows? Because each year is on its own.
Right. But even if you're accrual basis, okay? So you incurred the expense, you paid the expense, you deduct the expense, the loan is still outstanding. Now the loan gets forgiven. Now it's not, you don't have to pick up the forgiveness of loan as an income. It's the expenses that are not deductible, but the expenses were incurred and paid in 2020. So I think that a proper guidance by Treasury and by service would be helpful, because otherwise, because I've gone through a couple of seminars, even with AICPA, and I think everybody is still waiting for a guidance here. So that's why I had to answer how this is still not clear yet, okay? And I'm assuming this question is coming up all the time, and IRS will come up and give some guidance.
It's certainly surprising that when they came out with their initial announcement, it wasn't so broad as to discuss these issues. Because you're right, there is no clear answer at this point.
Well, we are out of time, and I want to be respectful of both panelists and participants' time. I'm going to put up here on the screen just for a moment all of our contact information, our telephone numbers and emails. If anyone has questions about anything that we talked about today, or if you'd like a copy of these slides, please don't hesitate to reach out to me, and I'll try to answer, or to reach out to some of the other panelists. As I think we've said, there are still some areas of uncertainty for sure. And there's some questions that we'll hopefully be getting more guidance about, but I think there are definitely some areas of lack of clarity. So I appreciate everybody participating today. I want to thank my co-panelists, Jeffrey, Suhas, Robert. Thanks for your insights today. And as I said, you should receive copies of a link to a recording of today's webinar. And if you have particular questions, please don't hesitate to reach out to us.
Ivan, before we end the seminar, can I just remind all our listeners about one thing, and please confirm this for me. If a business has applied for loan forgiveness of $1 million, has received $1 million PPP loan, and the amount forgiven is, let's say, $800,000, so the $200,000 is still a loan. If I remember correctly, that $200,000, which is still a loan, has to be used for specified purposes. You cannot just use that for anything and everything. Is that correct?
That's correct. The statute says that whether you apply for forgiveness or not, you can only use PPP loan proceeds for a relatively narrow list of items like payroll, mortgage interest, utilities and rent. So that
Right.
is
I just wanted all the seminar participants to remember that I think it would be a violation of law if you use those proceeds for any purposes other than what the original purpose is.
Right. Absolutely right. Absolutely
My
right.
understanding as well.
Right. All right.
And that's our understanding as well. Just one other point about it. I mean, even if you don't get a 100% forgiveness, it's still a 1% interest rate for 5 years. So it's not the end of the world. But, obviously you want that 100% forgiveness. But if you don't get it, well, it's, 1% is not very much to pay for working capital that you were able to use to offset the cost of keeping your employees on the payroll if your revenue is reduced.
Thank you.
All right. Well, thanks everybody, and hope today's session was helpful. And again, feel free to reach out to us if we can answer particular questions. Thank you very much.
Thank you.